Hello, everyone. Dr. Blount here. Just wanted to give you a little bit more information on what it means to be fine, financially independent, nurtured, and empowered. As I mentioned before, the concept and really the approach is based on two objectives, financial education and financial therapy. Financial therapy to help address some of the confidence issues, but there's also going to be knowledge issues where we have to fill the gap, and that's where financial education comes into play. For each of the letters here, I have 13 concepts that I think will help as you grow and build in becoming fine. It'll just help you with more money concepts, more descriptive information about financial products and services, or just strategies so that way you know how to move forward. But we'll go through each of these in a very sequential way so that way you can take in as little or as much information as you would like. So let's start with the letter F. And let's make sure that we have some good concepts when it comes to just base financial information. Each of them will have some concepts that we can go through that'll make it very easy for you to apply this to your life. So under F, one of the first things that we deal with is establishing financial goals. It's important that you have some type of amount, a time frame, and really an idea of what you want to do in terms of how much money you want to make, when you've made enough, and then how you want to live your life once you have stopped earning money and want your money to start supplying you with more happiness and fun. And so, as a base concept, just having better financial goals gives you more clarity as to what the future may hold. We then move into SMART goals, which are just very specific, measurable, achievable, relevant, and time-bound goals. When you come up with a goal, make sure that it's something that you can actually achieve in a reasonable amount of time, so that way you can see the impact of it. You see the influence of your work on the outcome, and so you're therefore more likely to continue to establish those goals. So SMART goals help to make sure that our financial targets, they're clear, they're realistic, and they're trackable, something that we can all try to get on board with to help you achieve all of the goals that you have. Budgeting is another important concept. It's not really something that's easy, but it's necessary because you really just have to retain some of your earnings. As you make more money, you just have to make sure that one of the things that you're doing is taking care of just the base needs that you have, your expenses and your savings, but to make sure that in terms of what you're earning, that you pay for everything and you retain a certain amount. And that's the purpose of budgeting, not to necessarily save, but to make sure that you have this habit of actually going in and retaining some of the earnings so that way you can do something with it. Saving, on the other hand, is something that's habitual. You want to do this every day, every week. Just allow yourself to achieve the best possible rate of return that you can get to. Bank savings are not necessarily ideal because they're less than 1%. So ideal savings would be somewhere between 3 and 5%. And it's something that allows you to just buy time in the future. And so it just creates this habit of putting something away for something you plan on doing in the future. A lot of people may say, hey, if you're going to save, why don't you save for an emergency fund? And it's good to have an emergency fund. Think of it as a safety net in case unexpected things were to occur. But just in normal life, a lot of unexpected things occur. And so emergency funds need to be away from you. I like to think of sometimes like retirement accounts as your 401k as having an emergency fund component because you can go in and take out a hardship withdrawal if you need to, but it's not something that you have access to all the time, and there's certain procedures that you have to go through to get it out. So an emergency fund should be something that's pretty much tucked away, and you can only kind of break glass in the case of emergency. And then we should just understand what investing is. We're trying to just make sure that we grow wealth and we achieve some long-term financial goals, but when you invest, you're giving your hard-earned money to some organization, and you need to believe in that organization. You either believe in their product, you believe in their leadership, you believe in their business model, but just simply believing that the price will go up is not enough when we talk about investing. Investing is taking on ownership, taking on equity in an organization, and therefore it allows you to grow your wealth, but you also have a responsibility. One of the concepts that's important is diversification. It's where you just spread out your investments over more asset classes, so that way you can reduce your risk. But I really like to make sure that people don't over diversify. I often like to give the analogy of you only need one umbrella to go out into the rain. And sometimes, as long as you have at least 50 or 60 stocks in a portfolio, you've reached a true point of diversification where you spread your risk out as much as you possibly can. But just simply adding more securities does not take away any risk. So whether you have 50 stocks or 5,000 stocks, it's not going to protect you more. And so diversification simply means spreading your risk out among a larger portion of securities, but you can't avoid it altogether. And so you don't need to have 10, 15 mutual funds. One mutual fund will do, especially a really good one. But when we talk about diversification, that's different from asset allocation. When we talk about asset allocation, we should have investments that represent different industries or different sectors. So you shouldn't have all of your money in, one company representing one industry, like a restaurant, for example. If I had all of my money in McDonald's or I had all my money in Coca-Cola. But I could actually have a mutual fund or asset allocation that is the beverage industry, right? Or the restaurant industry. And so I'm able to actually have investments in diversification in specific industries and sectors. And when I'm able to do that, that's called asset allocation. One of the best ways to build wealth is through what's called dollar cost averaging, which simply means that you just consistently put your money into some investment, regardless of whether the price is going up or down. What happens is over time, it just equalizes out. And so dollar cost averaging just simply means that you buy more shares at different prices. And then on average, you get to a better price for you where you can actually make a return. There's also just the very basic concept of financial literacy. It just means understanding personal finance. But sometimes we forget that it's understanding personal finance and economics, right? It empowers you to make financial decisions like, should I buy this or should I save X or should I invest in Y? Those are going to be decisions that you make not only for your base needs, right? I have to shop. So what are some of the things that I do want to spend my money on and who do I want to shop with? That's the economics part. And then how can I actually do this in a way that allows me to grow? That is going to be the personal finance part. So financial literacy is the combination of both personal finance and economics to help you make better decisions overall. And then there's financial therapy. It's an interesting concept because it deals with the emotional relationship that we have with money, and it helps us develop a better relationship. If we have a negative emotional relationship with money, it makes it very difficult for us to move forward and progress and try to do the things that we want to do to help us out in the longer term. However, with a positive relationship with money, it allows us to feel motivated and encouraged and actually move towards those goals a little bit faster. And so addressing that emotional relationship with money allows us to identify whether it's positive or negative and how we can move forward in the best possible way. Paying yourself first is really just an idea of prioritizing you so that way you don't deprive. If there are things that you want to do, if there's goals that you want to achieve, if there are objectives in your wealth building that you want to actually solidify, do them before you do that for anybody else. Because if you don't, it can cause regret. at some point. And so if you pay yourself first, if you do the things that prioritize you first, and you don't deprive yourself, it gives you more of an ability to not regret certain decisions later on. And then just have a really good idea of what you're spending your money on. Like, what are you actually trying to spend your money on? Obviously, there's a lifestyle, paying your bills, but then how do you want to spend the rest of your money? Think of some of the other things that you can do with your money and how it supports your happiness. Be very purposeful in spending your money and conscious of some of the things that are making spending satisfying for you, as opposed to that feeling of it being frustrating or disgusting or creating a certain degree of sadness. And so a conscious level associated with our spending is always helpful. But then focus on the I, which is all about independence and trying to make sure that we know the ways that we can create income for ourselves. And so I, and the concepts that are associated with that independence factor, will allow us to move forward. And again, there are 13 concepts that I think are important to understand when it comes to just making sure that you feel that independence. First is we'll talk about debt management and just making sure that you have a plan to eliminate your debt. It doesn't just mean paying off your bills, but it means this process of taking on debt so that way you're able to achieve certain things and then having a reasonable plan of paying it off. So it takes away some of your stress, but it also gives you a degree of financial freedom. And so the way in which you manage your debt really allows you to have more wealth if we can do it pretty successfully. And that simply means understanding the difference between what good debt is and what bad debt is. We need to actually finance things. We need to take on debt so that way we're able to gain more assets. And so it's not a good belief system to say, oh, I just don't want to take on debt because all debt is bad. That's not the case. When we finance a car or we pay a mortgage or we're using credit cards to give us like emergency and flexibility, those are good forms of debt. However, when we just have credit cards and we spend it just for retail therapy, that's not. And that just creates a higher expense, more useless items, and kind of it's probably masking something else that's a little bit different. And if we're talking about debt, whether it's good or bad, it's important to know what your credit score is. And your credit score is something that is an algorithm generated by a company known as FICO. And FICO kind of creates a certain scoring system. And the scoring system allows companies to have a range of what they believe is a reasonable amount of risk associated with you based on what's happened over time. It's important to note that the FICO scores are pretty standard, or credit scores are pretty standard type of algorithm and equation. And what that does is it feeds into credit agencies. And as a result of that, those credit agencies generate what are called credit reports, right? And so each agency is able to generate a credit report based on their criteria and their evaluation and their interpretation on what your credit score is. And so a credit score feeds into our three different credit bureaus or credit agencies. They produce individual credit reports, and those are the things that we see most often that list the items out that are delinquent or that are subject to some type of collection. Should also be aware of interest rates. If we're using good debt and bad debt, that's the cost of borrowing. So it's really how much it costs us to take on any form of debt, good or bad. And if we're taking on good debt, it's usually reasonable price, and we know bad debt because they have high interest rates, which means that we don't really have an opportunity to grow wealth. We're more so paying the expenses. And so ensuring that we are actually getting the right interest rate when it comes to our debt is going to be important. It's also important to consider your interest rate. Like you have to increase your income and your earnings every year. Why? Because things around us go up in price, and that's called inflation. It's where the cost of goods and services are going to go up by a certain percentage every single year. And if you don't keep up with that increase in that percentage, what you're going to see is a loss of your purchasing power. And so inflation really gives you a guide of how much you need to increase your earnings every year, and whether or not you're in a winnable situation or not. If inflation is growing higher every single year, then the amount of money that you're making, if your earnings are not going up by equal amount, at some point you're going to be doing the same amount of work, and it's going to be worth a lot less. And so simply understanding inflation helps us to understand our self-worth a little bit better. And then there are certain opportunity costs, and it's hard to really conceptualize this, but sometimes you really just need to just take a risk. You actually spend the money so that way we take an opportunity, because the potential benefit is going to be better than any of the alternatives that we have. And so when we look at opportunity costs, it's when we spend money for something that is beneficial, right? We look at it as something that can be a potential investment. Like, for example, going to college and paying that tuition, that's an opportunity cost. Why? Because it leads you to higher earnings over time, less regret as you get older, as opposed to how much you could have made or what you could have did. And so we invest that money now, we pay that expense when other people are not. Why? Because it gives us an opportunity to do something with it in the future. Because after that, it just becomes a sunk cost, right? It's a money that we paid, and then we need to benefit from it or grow. Because there are going to be certain times when we just pay an amount of money and then we have to go and be successful. It sometimes happens if somebody takes like 1 year of college and then they drop out, but they have 1 year of student loans. That is just going to be a sunk cost. You've taken 1 year of college, so you haven't completed the entire curriculum, and you have a year of debt that's not really going to allow you to benefit yourself. And so now we just have this sunk cost, a bunch of money that we've spent that we can't really do anything, that may just lead to other bad financial choices. In reality, if you wanted to only take a year, like take 2 years and then drop out, because at least you're able to get an associate's degree and you're able to do something with that. But really taking out a loan for school and then dropping out after the first year, it really just puts you at a really big disadvantage. And then when it comes to debt, we can think about different ways to pay that off. One is called the snowball method. And that just simply means if I have several forms of debt, like credit cards and car loans or whatever the case may be, that I start paying off the smaller ones. And once those smaller ones are paid off, I can move on to some of the bigger ones. And so it helps when you're just you really want to just pay off something really quickly. However, sometimes we can deal with what is called the avalanche method. And so we just pay off the highest interest rate first. Why? Because it's costing us the most. And if we actually take that debt away first, then we're not wasting as much money. We're not paying as much in interest costs. And so that would be a much better situation for us. There's then risk tolerance, which is how comfortable you feel with investing. No one feels comfortable with it, but it's something that needs to happen just to be able to increase your wealth. And at a bare minimum, when we look at the equation for risk, we normally say 3% is the lowest amount of risk or is the lowest return that somebody should look for if they're not willing to take on any risk. And so that's pretty conservative. So if we have a fairly low risk tolerance, we're probably looking at something that's going to average around 3 to 5%. Whereas if we have a higher risk tolerance, we can actually stomach investments that can gain 10 or 15%, but it's going to happen with some volatility. And so that allows us to really have a better understanding of what the risk tolerance is. And financial independence is essentially what it sounds like. It allows you to know that you have enough wealth. You don't need to be rich. You just need to have enough so that way you can live without working, where your money is working for you, or you're able to attain or influence the way in which you can get cash flow. And so as a result of doing that, you're able to achieve financial independence. And that doesn't necessarily mean you need massive amounts of wealth to do so. And that's really the old way of thinking about retirement, where we just save and we do so over a period of time. And at some point when we're older, we get to just retire and be happy. But if we just want to work for a period of time and then we don't want to, that's still a part of retirement planning, right? It's just preparing for what we need to do financially when we're not working anymore. And we can decide what that number is. It doesn't have to be 65 or 62 or 70. It can always be your choice. And that's one of the things that retirement planning is very nuanced and understanding. And then we go to the N. And the N really means the nurtured relationship. You feel like you've been heard and healed and helped. But the concepts in there really allow you to move a little bit forward, where we're able to make sure that you understand everything that's out there. And we're challenging some of those limiting beliefs that you have. And we start this process of moving forward. And so these concepts, the concepts that fall under the N, are really around accelerating your wealth building journey. And then how do we move forward? One of the ways that we can do that is by investing in stocks, right? They represent ownership in a company. There's a ability for these investments to grow because they are companies that sell products and services and do so on a regular basis. And so I want you to think of stocks as having ownership in a company, right? You own this, and so you're able to make decisions and vote and also be a part of the gains that are there. You can share in the profits. And bonds are different. Bonds are a form of security that's debt. And so you are loaning your money to somebody. The most common form is like what we would see a government bond, right? So you're loaning your money to the government, and as a result of that, they're going to pay you a stream of income, and they're going to call that interest. And so whereas we seek out stocks to appreciate our wealth, when we actually achieve a certain amount of wealth, we look for bonds to provide us that steady stream of income. That mutual funds are by far one of the best savings vehicles that's out there. It allows you to pool various types of investments, have very high diversification, and as a result of that, have several degrees of risk that are very palatable for a lot of people. And so mutual funds can be this ideal savings vehicle for a majority of folks just because of the way it's able to collectively diversify both stocks and bonds into a portfolio and then just let you buy into that. And there are different types that allow you to invest based on your own preferences or where you think you will be the happiest or have the most involvement. There's also what we would call an exchange traded fund, which is nothing more than a mutual fund that's treated like a stock. Mutual funds in general are good savings vehicles. They're only priced at the end of one day, and you don't expect to have a lot of trading in them. You just put a lot of dollars in them. However, if you wanted to treat a mutual fund like a stock, you could do so with what's called an exchange traded fund. And in that case, it moves throughout the day. You're able to trade it at various times throughout the day, and it doesn't just have one closing price that it has to mark as its going price for the day. We then have index funds. And so often you will hear about how the market's doing. And so they may reference the Dow Jones or the S&P 500 or the NASDAQ. And so think of an index fund as as a mutual fund that basically follows one of those indexes. So it's a mutual fund that looks and has a lot of investments that are in the Dow Jones or in the S&P 500. So there's a S&P 500 index fund. That simply means that it's a fund that's comprised of everything that's in the S&P 500 index. So as you see on a day in and day out basis that the S&P is up or down, that's how your portfolio is doing on a regular basis. It's passively managed, which means we just copy what's going on in the index, and there's really no active management of that. Dividends happen when you are either shareholders of a mutual fund or of a stock, and it's where you actually receive a portion of the earnings. And so if a company is doing well or a mutual fund is doing well, they can pay you a dividend or a stream of income. And that's how we can actually use our investments to generate income for us in the future. Capital gains are what we all hope to achieve. It's the profit that we are expecting from a stock or a mutual fund. But if it goes up, that just simply means we have to make sure that we pay taxes on it. And so a capital gain is usually just a profit that you get from selling investments at a higher price. Right. So if I buy a stock, I buy a mutual fund, or buy an ETF and it ends up going up in value, yay, I make money. That money that you make is called a capital gain, and then you'd also be taxed on that capital gain. And then as you start to think about what you're doing with your investments, how do you actually grow your wealth? What happens if you die, if you pass on, and then you want to ensure that your wealth actually follows the instructions that you want for your wealth to transfer to your family or to organizations? We would put that information in what's called a will. And so it's just a legal document outlining how you want to have all your assets distributed. And so if you're buying stocks and bonds and mutual funds and ETFs, like what do we do with all that in case you die? And then there's also trusts. And so trusts are just arrangements, and think of it as you can set up specific companies just to put some of your assets in. And so we can set up trusts to put stocks in, we can set up trusts to put real estate in or precious metals. But trusts are just legal arrangements or entities that allow you to store assets as much as you can. Then we have what's called a power of attorney. And a power of attorney is usually what happens when you give financial decision-making authority to someone else. And so if you work with a financial advisor or financial consultant, you have an account, it's your account, it's your money, but you can give the control, the financial decision-making to someone else to go in there and place the trades for you and manage the assets. And so it's your account, but a power of attorney allows you to give control, designate someone else to actually make those financial decisions for you. And in a similar way that a power of attorney can do that for your assets, a health proxy is something that can be used to allow someone to make medical decisions on your behalf. And so the combination of not only having something that's good like a will or trust or being able to have something that speaks on your behalf like a power of attorney, also having a healthcare proxy to have someone speaking on your behalf for your medical decisions is incredibly important. Sometimes we don't think about the concept of frugality, but it doesn't mean cheap. It just means that we're actually having more mindful spending, right? Conscious spending, mindful spending, purposeful investing, purposeful saving, outcome-driven types of actions. And it just means that we know how to take our time and take our pace. And it doesn't mean that you're cheap. It just means that you have a plan. And frugality helps you achieve your plan a lot sooner than if you did not practice frugality. And then an important tool to help you grow your wealth is the credit card. Sometimes using cash is not something that's possible, just depending on how often people get paid and how frequent their cash flow is. And so credit cards allow you to conduct transactions and experience revenues on a day in and day out basis without having the physical cash necessary. And so it's part of that ability for you to grow your wealth is having some flexibility to use designated credit at your disposal when it's needed. And we get to that E, which is the last part, which is this feeling of empowerment, being empowered. And the concepts here should allow you to actually move forward and towards your full objective and your happiness and create sustainability. So now that we have some base concepts, now that we have an understanding of the ways in which we can create cash for ourselves, and we have a way of moving ourselves forward in terms of understanding the vehicles that are there to help us grow our wealth. How do we actually start to do? How do we make these things a reality so that way our decisions and actions are moving forward? Well, these concepts should help. They are there to allow you to understand what's in front of you and not feel fearful of it, but just look at it with a degree of certainty so that way you can move forward. Compound interest is important because it allows us to understand two things very easily. And I'll speak first about expense side. If we don't pay our credit card bills and we just allow this interest to accumulate, at some point we're paying more for the same goods and services that we're paying more for goods and services than we should, basically. Because we're delaying the repayment and interest is being added on, something that costs $10 is now $11. And in a month, it's going to be worth $12. And so now we have $2 of interest that we shouldn't be paying because we needed to pay $10. So now we have to pay 12. And so simply understanding what compound interest is and how it takes more of your own capital and your income away allows you to do things to prevent that from happening. One of the things that we can do to prevent that from happening is understand the concept of the time value of money. Meaning, if I put my money away and I invest it into something that I want to grow it to, then instead of me paying interest rates to other people, what I'm doing is I'm actually paying myself more money in the form of additional money over time. And so that's what time value of money actually means. If I put money away for some specific rate of return, in the future, I'm going to have more money, right? $1 invested on January 1st is going to be worth more on December 31st, just because of time, right? Just because of time and a rate of return. And so if we keep those two things in mind, we can always find a process to make money. And that's what leads to net worth. Net worth is an equation. It's when we look at our assets minus our liabilities, and it's really how we look at our financial health overall. It's important to realize that a lot of people don't have net worth because we don't have assets. We have more liabilities, we have more bills, but a lot of people don't have assets like a home or a car or retirement accounts that allow them to actually have net worth. So a lot of people actually have a negative net worth. More than half of Americans have a negative net worth simply as a result of doing that. And when it comes to the way our interest rates or the way inflation or the way compound interest or the way that we are looking at time value of money, there is either going to be a fixed way, a very static way where it doesn't change, or it's going to fluctuate a lot. And if it's static, we're going to call those fixed rates. And if it changes a lot or fluctuates a lot over time, we're going to call those variable rates. And so when we look at interest rates or the compounding interest or time value of money, all of those are going to be determined based on whether you are experiencing a fixed rate, something that doesn't change, or a variable rate, something that changes over time. One of the things to keep in mind is that we are often quoted rates based on what happens in a year. However, oftentimes they may be what's called accrued or paid to that individual or that entity on a monthly basis, on a quarterly basis, or whatever the case may be. So you may receive like a monthly payment for 12 months, and then they sum that up to say this is the annual percentage rate. So be aware of how your rate is actually being calculated. Sometimes it could be fixed or variable, but be aware of whether it's actually being accrued and actually paid or calculated on an annual basis, or if it's just accumulating monthly rates or quarterly rates and then calling that its annual percentage rate. That's how you compare and contrast what is good for you and what may not be good for you. We didn't have tax advantage accounts. Like the IRA is the most common one. And what's beneficial is that it allows you to grow your assets, achieve capital gains without having to deal with that tax at first. And basically what will happen is that your money is able to grow without those taxes. And then as you get older or as you move into a lower tax bracket, that's when you spend the money and therefore you're going to pay tax then. And so that's the advantage with the tax is that we get to defer that tax on our growth. And then when we actually spend the money later on, we're paying a much lower tax rate. And most of the ways that you can find these tax advantage accounts are going to come from your employer sponsored retirement programs. And they all are going to have different names. They can be called a 401k, a 403b, a 457 plan. They're all the same. It's an employee sponsored retirement program. They just have different tax ramifications. And so they are just named after different tax codes, the 401k, 403b, and 457. The 401k is for uh, organizations, private and public organizations, for-profit organizations. 403Bs are for nonprofits. 501Cs are for nonprofits or churches or stuff like that. 457s are primarily governments, municipalities, local state government retirement plans. We all have a basic retirement plan and it's called Social Security. We start paying into it the second we work, and then we become vested in that after 10 years, and our money just grows for us. And Social Security is one of the best insurance products ever created. It uses your own money, it stores it away, it grows it for you, and uses time value of money, and then it automatically converts it into some stream of income. And there's not another product that's able to do that. And so Social Security is very unique in the way it's able to do something like that. A lot of us used to have pensions. So the baby boomer generation used to work for a company for a very long period of time, and they would have what's called a pension, which was a defined benefit plan. And they don't really exist. They're 100. They don't really exist as or as prevalent as they were before. They do exist in certain industries. So if you have unions, for example, teachers still may have pensions. But one of the things to keep in mind is that this is done by the employer, right? So it's employer funded, completely employer funded, and it gives that employee some portion of their salary, right? 2/3 of their salary once they get into retirement. Annuities are important in terms of a concept to understand because that's where you create periodic income. So regardless of how much wealth you have, if you want to have a stream of income, there's only a few ways to do so, and annuities are one of those ways. Bonds are the others, where you take this bigger amount of money and you turn it into a stream of income. And so when we talk about annuities, we're talking about creating a stream of income from some bigger pool of money. And one of the best ways to do that is through insurance. You have to protect yourself against financial loss. There's no reason to go on this wealth journey, save for yourself, do everything that you possibly can, and then have something happen that puts it all at risk. And so insurance protects you. It also indemnifies you, what's called brings you back to the place where you were, right? It makes you whole again, is what's the purpose of insurance. Estate planning is just a preparing your wealth portfolio or your assets for wealth transfer when you die. So upon death, how do we actually take all of the assets in the portfolios that you have and just move it over to somebody else that you designated? That process is called estate planning. This process of taking your wealth and upon death moving it to another generation or another part of your family. And then sometimes we have to think about how much, once we accumulate, how much are we trying to withdraw? And so for a long time, there's been this concept of if you can withdraw 4% of your actual income or 4% of your accumulated wealth for your income, that should help you survive. And so what we try to think about is how much money is it going to take for you to live comfortably for a year? And then we're trying to look at 4% of that, and 4% is going to be that annual salary, and then we're going to look at a bigger total to come from there. Okay. So for example, if we wanted to pay you like, I don't know, $40,000 a year, we'd have $1 million paying you 4%. And then it just allows you to get that amount of money that helps you out. Okay. And so those concepts, that's going to finish up for the E. And so at the end of this, empowerment is what you should experience. I hope it's been helpful, and I hope that it provides at least the right degree of oversight and understanding in what it takes to essentially be fine. And if you have any questions, always here to help.